This is joint work with Greg Bujek, who's at Stanford University. And in this project, we study how mortgage lenders compete and how local competition affects credit access. Now, our project is motivated by a stark wealth inequality across race in the US. On the right-hand side, I've plotted the median household net worth from the Survey of Consumer Finances. And we see that while the median white household has a net worth of $188,000, the median black household only has a net worth of $24,000. Now, to understand wealth inequality, it's critical also to understand that for the majority of households in the US, wealth is accumulated through home ownership. For example, while the median homeowner has a net worth of $255,000, the median renter in the US only has a net worth of around $6,000. So how does access to housing affect wealth inequality? Well, unfortunately, there are large disparities across race in terms of access to mortgages. On this slide, we see that while the average mortgage application denial rate for white applicants is 7%, it is twice that at 14% for African American borrowers. So this is the starting point for our project. We ask, maybe somewhat provocatively, can capitalism help this problem? Now, what do we mean by this? Well, one of the hallmarks of capitalism is competitive markets. And there's this idea that goes all the way back to Gary Becker, which is that greater competition can act as a strong force in reducing discrimination. Here's a personal anecdote. Greg, my co-author, and we started working on this project when we were both PhD students at the University of Chicago. We'd just taken a microeconomics class that was taught by Gary Becker. In this class, Becker had talked about how competition can reduce discrimination in the labor market. And we were curious about whether this was also the case in financial markets. So this is the motivation for our research project. In this project, we ask, how does mortgage competition affect credit supply? And we find that when local competition increases, that leads to increased credit supply. And importantly, increased local competition seems to benefit marginal borrowers the most. What's an important potential policy implication from these findings? Well, we argue that regulators who are concerned with credit access, they should regard mortgage markets as local, which will lead to stricter thresholds for mergers across mortgage lenders. All right. Now, I'm not going to bore you with all the technical details of this study. I'll just mention that in this study, we use 3 data sets that are common and standard in the mortgage literature, which is Fannie Mae and Freddie Mac data from the GSEs, private data from Black Knight, and publicly available data from the Home Mortgage Disclosure Act. The empirical methodology that we use in this project is we're using 3 different instrumental variables. So we are studying bank mergers, failed banks, and changes in bank regulation. And these instruments will allow us to tease out what's the effect of changes in local competition on credit access and credit supply. What do we find? Here's our first finding. We find that in markets that are more concentrated, so higher concentration means lower competition. In local markets that have higher concentration, there are higher rejection rates. How do we see that? On the left-hand side, we've plotted a bin scatter plot where the x-axis is the market concentration at a county level last year. And on the y-axis is the rejection rate, so this is just raw averages. How often do mortgage applicants experience that their mortgage applications are denied? And we see a clear positive relationship in more concentrated areas. There are higher rejection rates. We go through this standard battery of empirical analysis, so we control for everything we can control for. We use instruments as well, and the results hold even when you've gone through the technical ringer. So on the right-hand side, I've plotted the same plot, but now I've controlled for all types of demographics and county and year fixed effects. And again, we see a positive, significant relationship showing that in counties where there are higher concentration rates, there are also higher denial rates. Now, who benefits from more competition? In this plot, we've split the population into high income and low income borrowers. We just split borrowers, but whether they're above or below the median. And on the left-hand side, again, I've plotted the same plot as before. So the x-axis is lagged market concentration. If we go all the way over to the right, these are areas, counties in the US with very high concentration. So maybe it's only 1 or 2 banks that are serving them. On the left-hand side, there's very low concentration, or vice versa, very high competition. In red are rejection rates for borrowers who are in the top 50% in terms of income. And in blue, rejection rates for bottom half, the low income borrowers. And what we see is that there's a level difference. Poor borrowers have their mortgage applications denied at a higher rate than wealthy borrowers. But interestingly, the difference between high and low borrowers increase as local concentration increases. We can see that as well over on the right-hand side. So on the right-hand side, we've plotted the gap, the difference between the two lines on the left-hand side. So the right-hand side plot shows what is the difference in application denial rates between poor and wealthy borrowers relative to how concentrated the local market is. And we find that in markets that are very concentrated, there's a higher denial gap between high income and low income borrowers. We do the same studying minority borrowers. So here again is the same plot as before, but instead of grouping by high and low income, we group by white borrowers and non-white borrowers. On average, the red line is below the blue line, meaning that on average, white borrowers have a lower application denial rate than non-white borrowers. It's similar to one of the first graphs that I showed. Interestingly, the difference between these two lines on the left, which is what I'm plotting on the right, increases in concentration. So let me explain what that means. That means that in areas in the US that have a lot of competition, those are the areas on the left of the graph, there's a much lower gap in denial rates between white and minority borrowers. Whereas in areas in the US where there's maybe only one single bank, where maybe a bank has a monopoly in this area, there's a much higher denial rate between white and non-white borrowers. Another way of saying that is that marginal borrowers, those who are low income minorities, are those who benefit the most from increases in competition. Now, of course, mortgage markets, mortgage products are multidimensional. One thing is whether or not your mortgage application is accepted. Another thing is what do you pay for your mortgage once you're accepted. Here we're looking at 2 dimensions of the cost of a mortgage. We're looking at how much do you pay in interest and how much do you pay in upfront non-interest points and fees. On the x-axis is how much you pay in interest over the going rate at the time, and on the y-axis is how much do you pay in discount points in percent of the outstanding loan. We plotted 2 different lines. So we plotted a line for counties that have high concentration and counties that have low concentration. So in blue, these are areas where there's a lot of competition. The areas in red are the areas where there's maybe only one bank that has a monopoly. And what we see is that in areas with a lot of competition, those lenders charge lower fees and lower interest rates. Sorry, let me say it again. So controlling for what you pay in your interest as an interest rate, you pay a lower fee if you apply to a mortgage in an area where there's more competition. To put some numbers on this, we've split up. We asked how much cheaper is it to apply for a mortgage if you apply for a mortgage in an area where there's a lot of competition. So we're asking how much can the average borrower save if there's increased competition in the mortgage lending market. So on the left-hand side, we've plotted a bin scatter plot of upfront point and fees relative to the local county level concentration. And if we compare the top quartile in terms of concentration with the bottom quartile in concentration, we see that the average difference is around 70 basis points, which turns out to be more than $2,400 for the average borrower. We can do this in a statistical model as well, where we're controlling for observables, and we see the same result. All right. I think I'm almost running out of time, so let me just finish with my policy implications. In this project, we show that the previous literature has found that there's little to no relationship between the local lender concentration and mortgage interest rates. Now, consequently, federal regulators who have regarded mortgage markets as national, so that means that they essentially view local concentration as irrelevant when evaluating mergers. And we, in this paper, we challenge this assumption, and we show that, in fact, local concentration strongly affects lending standards and upfront fees, which means that we think that regulators should take into account local concentration when evaluating, for example, bank merger approval. Thank you, everyone. I'm looking forward to your comments and questions.